it sounds like you're open to stocks here.
Yeah, Kelly, until you get a legitimate reason to sell, which historically has been a true change in Federal Reserve policy, and that would come because inflation and the economy are heating up to such an extent that the Fed has to dial back its easy money policies, then yes, then you sell. And as Bob said, look, we're always open to a correction of 5, 10, 15%. That could happen for any number of reasons. But right now, you've got a market that has, strong economic growth. You have inflation indicators that have been troubling over the last couple of weeks rolling over. In fact, have been doing so now for a couple of months. And so that takes, I think, a little steam out of the necessity, or I think to mix a metaphor, it takes a little steam out of the Fed's efforts to have to taper here. So I'm not sure that there's anything currently in the way of this market other than maybe some temporary exhaustion. But those things tend to resolve themselves, at least favorably, until there's a real negative on the horizon.
Michael, you also sound pretty optimistic with a $4,500 price target for the S&P.
Yeah, absolutely. I think any kind of pullback should be bought. While we haven't had a correction, the markets, people believe the market's expensive. I don't think that's an issue for the equity market, and the earnings will decelerate. The reality is markets don't have sustained pullbacks or bear markets until we see earnings start to decline, and that's nowhere in the visibility here. A lot of the issues that people were concerned about earlier this year were really issues that could weigh on valuations of the market, such as inflation, higher interest rates, and the Fed prematurely tightening. We really don't think either of those are really as much of a growing risk as people thought they would be earlier in the year. Certainly bond yields have not gone up. The inflation issues that were more present earlier this year are starting to fade. Lumber prices are down 60 to 70%. Copper prices are down. Inflation will shift to wage growth, but that's initially a positive thing for the economy and for consumer confidence.
So, Michael, what are you worried about right now? I mean, you talk about earnings not necessarily being a problem, the inflation not necessarily being a problem. We saw the lumber prices back under control now. All the speed bumps in the first half of the year that we were worried about seem to be going away based on what you're saying. So what are the speed bumps for the second half of the year? What are the things that could pop up and maybe surprise us?
Sure. Let's see. I think investors look at the world right now, look at the macro data, and think we're at this peak macro environment. All of the data are really strong right now, whether it's housing confidence, manufacturing confidence. Yesterday, we got the 12th consecutive month where the ISM new orders index is above 60. We've got consumer confidence that is almost back to the prior highs pre-COVID. And so, I think what investors should expect is we're going to see moderating returns in the market. Over the last year, the markets are up a ton. And so as we get to this peak macro or high tide environment, it's going to become more of a stock pickers market rather than a high beta market, which is what we saw earlier this year. And so what concerns me is not valuation. I think the market's expensive because of the composition of the index today. So that doesn't concern me. Inflation issues are transitory in our view. The Fed is not changing their framework, but they could create, as we've seen, a lot of volatility in the market. But so aside from volatility, which I think investors should look for as an opportunity, there's really nothing that we see ahead of us besides something that's exogenous that could really hurt markets here.
Shepard Smith here. Thanks for watching CNBC on YouTube.